It's earnings season. We finally get a little bit of insight into what's coming in the next couple of months. What does 2026 look like? And importantly, today, we get to see what's going to happen to the Canadian oil and gas stocks. We're talking about Whitecap Resources earnings today. And if you don't know the story of Whitecap, it's been quite a whirlwind. They had that super big merger with Varen, basically doubling the size of the company. They sold off hard during the Liberation Day tariffs, and they've been basically on the up since then. But this earnings let us see not only how they've been going, what the sort of actual business performance has looked like, how those synergies are coming along, but it also gave us some insight into what next year is going to look like, what they expect from pricing, how they're going to deal with capital, and how we should expect the rest of the industry to adapt to what's going on in 2025 into 2026. We're going to start, of course, by covering what happened during the earnings, because there were some significant numbers here. If you look at the headline there, man, that's a $540 million beat, which is insane. Analysts way under anticipated what the revenues of this company would look like. GAAP EPS was 17 cents. And basically the two-headed snake here was, great production, huge revenues, like totally demolishing expectations, tough pricing environment. We saw significant profit challenges compared to what, could have been if the pricing had been a little bit better with that production. But still, like a crazy beat. That's an 83% year over year gain revenue, which is awesome. Their third quarter production was 374,623 BOE a day, which obviously exceeded their internal expectations, which included 227,419 barrels of oil a day, condensate and NGLs, 883,000 cubic feet of natural gas. For 2026, board of directors have approved a capital budget of 2 to 2.1 billion. That means that they're going for about a 370 to 375 BOE per day. So basically, they're running at these levels in 26. That's going to target 6% liquids, which is interesting. Fourth quarter average production rate exceeding that. So basically, the rate they hit now is what they wanted to hit next year. So obviously, they've really impressed themselves. They've significantly beat their internal expectations. They've also made some really big progress integrating assets and personnel, which is a big thing people were worried about. In those 26 forecasts, they got 300 million in capital operating and corporate synergies, which is way higher than anybody expected when these two companies merged. Now, obviously, thanks to all of this data, we saw the stock pop over the last little bit. But after the stock had popped and sort of the news story hit the headlines, I started to look a little bit deeper, because when I started reading what analysts were saying, sort of responding to this and going through basically like what did Whitecap predict? Why did they beat so crazy? That's a crazy beat. 540 million is crazy. I started to see some interesting points about what might happen next year. One of the analysts we cover quite often on the channel is Long Player. Now, obviously, in the name, usually like me, kind of hyper optimistic, right? That's the kind of analysts they are. They go through these storylines. They focus a lot on oil and gas, and they basically cover a lot of the really interesting and positive stories going on in the space. And there's a couple things in here that they point out. Significant exposure to strengthening natural gas market. I think that's a really interesting storyline, because if you look at the sort of mismatch in timings, I've covered a lot of natural gas and oil stocks over the last little bit, but if you look at it, natural gas has basically this winter, next year, and then maybe the year after that of like amazing pricing in North America, because we've had all of this expansion in export and demand basically, and the supply is not going to catch up, right? We had this like temporary shortfall that has sort of locked in even more supply. We've had the price of oil crashing, which is locking in more supply. Supply is going to struggle to keep up with demand over the next year, maybe 2 years, right? That's, consensus across the board from guys like Eric Nuttall through to people like me, right? So everyone from the institutionals to the retail, we're almost aligned on this. But oil obviously has a different story. Oil, we're looking at like significant challenges in the short term. Now, they could be like the apocalyptic challenges some analysts have predicted, or it could be as sort of gentle as Eric Nuttall has predicted, right? And he's been railing against this on Twitter. If you check him out, he's not a big fan of the whole oil glut storyline. He doesn't think that's actually the story we should be looking at. But either way, can't argue. Price of oil's down. That's impacting production numbers. Talked about the Permian so much. I'm beating this horse to death here, just constantly talking about the Permian. I get it. But hey, the basin has a higher cost than the high 50s, low 60s. That's just where things are at right now. And if you don't drill the new wells, you don't get the natural gas from those wells. So that, or like sort of challenging oil story, I'm going to put it that way instead of the death of shale oil. The challenging oil story right now in the Permian and a lot of those American basins is going to create undersupply for natural gas. That's basically a big part of why natural gas investors are just like super bullish right now. Everyone's excited. They're waiting. Winter's supposed to be cold this year, apparently. Not a meteorologist at all, but hey, that could be huge. Whitecap has outlined not only that, hey, look, that natural gas keeps us good for the next year. Oil picks up after that. Looks awesome for us. But it's also actually like outlined how they're going to take advantage of that. They're going to use that as part of their pricing mix. Really interesting. Profitability is going to increase over time. They obviously had some expenses coming with that merger. They've seen not only like significant synergies, but now also like significant free funds flow, significantly higher production than expected. So basically every step of the way, they're just these little wins that are compounding. There's a couple of interesting bits like going through the article, obviously. They talked a lot about the balance of the company between them and Varen. They talked about the new production, the plays that are so profitable that they've taken from that Varen. A lot of those assets are things that a lot of sort of institutional investors wish that hadn't, sort of come into this main company. But essentially, it makes the mix of resource that Whitecap has more profitable. And obviously, we've seen that in the production numbers here. They totally destroyed internal expectations. And I mean, even in a low pricing environment, very profitable. Costs are low. They've had some significant long-term results. Investors obviously should pay attention to the fact that they're not growing a huge amount next year. Share repurchases are going to be a consideration. We're talking about like significant free funds flow. Share repurchases make a lot of sense in that storyline. And here's where we get into what I think is really interesting about next year. Because obviously they didn't talk a lot in this earnings report about growing production. Because basically they managed to surprise hit their production numbers for 26 as early as Q3 25. But what they did talk about is how they can make it even more profitable for you to hold shares. And I think that story is so much more interesting for us right now. Because again, we've got this mismatched timing of natural gas and oil that basically means these companies are going to be, a little bit challenged with profitability right now with a huge boost coming later, but we don't know how huge that's going to be. We don't know what the sort of downside is going to be for natural gas. And that leaves us in a position where companies like this that are trying to like leverage those two things against each other are basically going to have their prices drop way down because of the oil, and yet their free funds flow are going to be higher than expected because of the gas. And because of that, they've talked about how they're going to take advantage of that storyline. You can see it right here, right? They talk about how they have turnaround activity Q3 next year. Obviously, they're going to spend some significant money on that, right? They're spending money on wells. They're spending money on both conventional and unconventional, but also they're prioritizing share repurchases. That's a huge storyline in my opinion. Share repurchases are such a good idea right now. And I know I am like the millionth person to say that, but I think share repurchases as we see stock prices continue to fall. And obviously I'm currently buying shares of all sorts of these big Canadian oil and gas companies. I've been sort of prioritizing the larger cap names, but there's often stories like Whitecap where you've got outperformance from smaller players, where you've got quality down the list. And when you see that, often that doesn't stay down the list for long. Right? The market cap on a company that actually manages to like dramatically outshine their own internal expectations does not stay small. These guys are going to grow. They're going to grow and grow. They're going to continue to see growth in their share repurchases, which is going to continue to return money to shareholders. And of course, they're going to continue to pay out one of the best dividends in the industry. They're paying out 7%, right? Like whatever, it's 6 and a bit right this moment, but 7% dividend, and it's covered with the ability to repurchase shares. That's wild. In 26, at a time when oil is crashing, we've got this generational supply glut and everyone is freaking out and selling oil stocks. These guys are saying, stop. That's not what we're seeing. That's not what's happening to us as a company. We're not suffering. And I think that story is one we should look for in these next couple earnings reports. We've seen guys like Strathcona come out. We're probably going to talk about them a little bit later. I'm waiting for this whole Cenovus Mega Energy thing to wrap up, but we're going to see obviously the majors. We're going to see C&Q. We're going to see Tourmaline. All these companies are going to report earnings. We need to watch for those kinds of stories. Where does the capital go in 26? How are they going to respond to pricing? What big plans are going to happen? What big expendings are going to happen? When are they going to happen in 26? And that'll give us a better sense of what is actually going to happen with the price of oil, with the price of natural gas. Because obviously these companies aren't going to be predicting amazing high profitable oil prices and then saying, oh, but we're not going to spend any money. We're not going to grow any production. We're just going to sort of like sit on our war chest here and try to survive. That's not the story, though. The story is actually that, hey, okay, maybe things are going to be great. We're not going to massively ramp production. What we are going to do is we're going to take advantage of where we're at now. We're going to make some investments that we need to make, and we're going to profit handsomely. Same time as we're doing that, we're going to just pay you a huge amount in dividends the whole time. So watch for that storyline. Really interesting to me. I think it shows that we've got a lot of positive, profitable growth coming in these companies in the next couple of years. And still institutional investors aren't touching them. Again, these guys beat by $500 million on their revenues. And I think the stock was up a couple percent. When have you seen that where a company can beat, like that's a 83% year over year growth? I know they're not saying it's repeatable and they'll grow like that every quarter, but where do you see those kind of massive beats? And yet the market sort of brushes it off because it's in this undesirable industry, right? As a sort of contrarian investor here who's looking for high quality dividend growth over time, almost nowhere better to be. And I love seeing this coming out of names like Whitecap. Really excited to see what happens with the rest of the industry. If this isn't on your watch list, I think it should be. Flat out. I'm not going to tell you what you should or shouldn't buy, right? What should or shouldn't be in your portfolio, but flat out, it's definitely in my watch list. I've got a couple of shares here and there, but man, if we see another pricing event like we saw in April, where, you know, maybe during that turnaround activity, Q3 26, you see some struggles, or maybe during the price struggles early in 26, if the stock starts dropping like anywhere near where it's at. So, you know, we talked about maybe $8, $7 were the absolute lows on the stock. If it goes anywhere near that territory, I am just piling on. I am scooping up as many shares as possible. That's my opinion anyways. I would love to hear yours in the comments down below. Obviously, you know, if you own the stock, are you happy with the earnings? Do you like what they said in the report? Are you interested in where they're putting their money 26? Would you rather see them growing production? Are you more bullish, more bearish? Love to hear that in the comments. Please do let me know. If there's other companies whose earnings you think I should cover, let me know that as well. I'm going to try to cover a couple here, but there's so many hell happening at once. It's kind of a challenge. So I'm trying to focus on the key storylines. And obviously, if you like this video, please do like it. You like what we do here on the channel, you like talking about these Canadian topics, please do subscribe. I hope I see you in the next one.